the IPO, or as you can see on the slide here, the initial public offering. That's what IPO means. You offer your company initially, so the first day, to the public. That's IPO. And why do you do that? Because it gives you a chance, on the one hand, and that's interesting with an IPO, to raise more money, because for the first tranche you offer to the public, the money flows into the company. And secondly, because your company is listed then publicly, the shareholders later on, after some lockup period, which is 6 months at least, have the chance to sell their shares to the public again. So the IPO, we look at that as an exit route on the one hand, but it's also a financing mechanism at the same time. And this is an important issue because what you have to show, especially if you want to do an IPO, an equity story that is holding on after the IPO. It's important for others too, but if you sell to a large strategic buyer, they have their own thoughts. If you sell to the public, you have to tell them what your equity story after the IPO is. Otherwise, nobody wants to buy the shares because then you have no value increase in your shares. And this is why the question, are you ready for the IPO, is probably most important in that case first. And many of companies are not ready for IPOs. I mean, if you look at how many IPOs are happening, there are more trade sales and mergers and so on than IPOs, more bankruptcies worldwide too. And if you compare that from country to country, you have a lot more in the US than in Europe, and you have more in Great Britain than in Germany, and so on. So an IPO market is important. So these are some of the external factors. What's the stock market situation, the general economic situation? We are referring to the financial crisis. When the stock prices go down, I mean, you won't get IPO premiums. You don't do an IPO. If the stock prices are up, if the DAX or the Standard & Poor's 500 or something like that is up, it's a good time for an IPO. So is the market there to receive also additional shares, or the capitalists who want to spend money? I mean, interest rates are low right now, so they probably look for alternative investments. Your company might be interesting. And what's the exchange rate level if you don't go public in your home country, but you're going to be listed in the US or any other country? So these are some external factors. More important are the internal factors. As I said, that is your company ready for an exit as an IPO? It has to be mature enough. It has to have an economic situation and perspectives which you can sell to the public, and you need own money. I mean, IPO is a costly thing. You might want to get some bridge financing to do that, but maybe you have the means to do that. So at least you have financials, and there has to be a capital requirement of the company. Because the money is flowing into the company, and you have to use that money properly. By the way, you as the entrepreneur, you have to remain on board in that case, which is also a positive thing. If you want to remain independent with your decisions, or comparably independent with your decisions, if you do a trade sale, the probability is someone rules your company is really high. If you do an IPO, there's no one else. There's the board, still the board, and you work with the board, but you're still running the company, and you still remain running the company. Remember the Yahoo people. The Yahoo people, they always want to be independent, at least the founders. So IPO is perfect for them to do that. If you do an IPO, actually, I mean, I can show you a list and checklist and all sorts of things, but you have many experts at your side. And it starts with the lead bank, and then this is the one you start talking long before you do an IPO. It's imperative. You need the bank to coordinate the IPO, support the process, do the roadshow, and so on. So selecting the right lead bank is really important, and you can look at some stats, who's doing how many IPOs, and the probability that they have potential buyers who will also buy your shares is very, very high. Maybe they have additional emission consultants. What you definitely need is a third group. You need tax consultants. It could be complex, especially if you go for an IPO in a different country. You always need some lawyers around that because IPO rules are complex, and you probably need people who to take you through that process by doing the roadshow with you and all sorts of things. If the lead bank is not doing that, it's someone else who do the investor relations together with you. So just looking at that, you can see that it is a very complex process. It depends a lot on the rules, and the rules in every country are a little different. So it's hard to have kind of like a general process for that. But be sure those guys know. The lead bank knows about the rules, and they will support you through the whole process. So keep the one thing in mind. I mean, we are still doing the venture capital investment. IPO is an interesting exit route for a company which is able to be big enough for that, which has a equity story and still will have an equity story. It's especially interesting because you fully remain on board, and it's a good probability for your old shareholders, for the VC, to sell the shares after the IPO, or at least 6 months after the IPO. So it's a nice exit mechanism, it's a nice financing mechanism, and it opens more doors. So this is basically also what the advantages are. Liquidity is coming, new money is coming in, but you're also there for more money sources, like you can place a debt round and public debt round. You get more standing because you do a roadshow, you do some publicity because you want to have the public to buy your shares. It gives you reputation, and it attracts people. People want to work for a publicly listed company a lot more than for a private company. Disadvantages, and you all know them. People say you live from quarter to quarter. It's the reporting. You have high reporting standards, probably higher than you had before to your VC. Your influence even goes back. I mean, because of all the rules, because of the things you have to tell the public. If something happens with your company, you always have to tell that immediately. It's costly, and especially it's very costly. And remember 2008, people started to prepare their IPOs. Financial crisis came, and they were not able to do that for the next 1, 2, 3 years. That's a bad situation for them because they invested money, they took some bridge financing maybe, and now they have to go on working with their old capital. Not a good situation. And I said that before, you have extensive stock law, which is different for each country, but that means you live from quarter to quarter. So as always, a couple of advantages, a couple of disadvantages. Remember, it's the only process which is financing round plus exit. Interesting exit, especially for those who want to remain the founders of the company, remain the managers, be independent.